And first we're going to review the accounting equation. Then we're going to do some brief exercises with journal entries. Then we're going to talk about adjusting journal entries, which is one of the main parts of this chapter, adjusting journal entries. And then we're going to do some exercises on adjusting journal entries if we have time to do that, okay? So first we're going to do the accounting equation again. Y'all had an exercise about this, for your first homework, right? And I sent the first homework back to you. You've seen your grades on that, right? And then if I needed to, I attached a sheet that explained, that where I marked it up as to what things you missed. Okay, so y'all seen all that, right? Okay, yeah, okay, all right. Looking at it a different way is through the accounting equation. So assets equals liabilities plus equity, that's the main accounting equation. And that's also the stuff that's found on a financial statement, which is the balance sheet, right? Okay, so all of this is on the balance sheet. And assets normally have a debit balance, right? And so since these are on the other side and they're equal to this, then these automatically have a credit balance, right? So a lot of times on the homework, you guys might get it right that something was an asset, but then you didn't get it right that it had a debit balance or something like that. So, think about these as all groups. All the things in assets have a debit balance except for a couple, right? Which we're going to go over those too. And then at the end of the extended accounting equation adds in revenues and expenses, right? So revenues increase your equity accounts, right? Revenues increase retained earnings, so they have a credit balance, and expenses decrease net income or your equity accounts, right? So they have a debit balance. Expenses have a debit balance. All right, so now just to we're just going to go over what accounts we're going to list the accounts. What are some expenses? What are some revenues, etc. Okay? So we usually start with the assets. Let's start with revenues and expenses. What financial statement do these guys go on? Income statement. Okay, so what are some revenues? Sales, okay. Sales and service revenue, okay. Or, interest revenue, rent revenue, those kind of things, right? What are some expenses? Rent, insurance, a lot of different kind of expenses. What are the kinds that y'all normally miss? Which ones does everybody kind of get wrong? A lot of times cost of goods sold, okay, that's an expense. What about depreciation expense? Okay, that's an expense, right? But there's a lot of other different expenses. What about prepaid expense? Is that an expense? Prepaid expense? Prepaid expense. Just the name prepaid makes it a asset. Okay, so prepaid expense, prepaid anything, prepaid rent, prepaid subscriptions, all kind of prepaids. Those prepaid insurance, those are an asset. Why? Because you've paid something in advance and you're going to get a benefit from it later, okay? So those are the revenues and expenses. Let's think now about the assets. So the obvious, first asset is cash. And then y'all just, accounts receivable. Inventory. Yeah, we're going at it, right? What else? Accumulated depreciation, because it kind of matches up with property, plant, and equipment, right? And instead, it's not really an asset. What is it instead? A contra asset. Okay, because it has a credit balance and offsets property, plant, and equipment. What else is a contra asset? Allowance for doubtful accounts. Okay, so this is a contra asset. Okay, so we've named a lot of assets. Maybe we'll just stop right there for a minute. Now, what about liabilities? What's our typical liabilities? Accounts payable, notes payable, rent, all those are kind of payables like that. Unearned revenue, yeah, that's a good one. Unearned revenue. So what is that? That is something that we're going to use in our adjusting entries. It's a liability because somebody has paid us for something when we haven't performed the service or given them their goods yet. So they paid us in advance, so we owe them something. Okay, are there any other liabilities we need to think about? Okay, what about equity?
Common stock.
Okay, so we have common stock and preferred stock, right? Now you put stock on the books at par. When someone buys your stock has a par value, and it's usually like $1 or $10 or something like that, and they might buy it for $100. But you put the number of shares times your par value in common stock or preferred stock. The rest you put in an account called additional paid-in capital. That was a surprise to some people, that account, right? Paid-in capital. Additional paid-in capital is a equity account, and it represents the amount that somebody paid for your stock over par value, okay? And so it normally has a credit balance. What else goes in this section? Retained earnings. Okay, so what is retained earnings? That's the accumulated earnings of your company that have not been paid out in dividends, right? So all the net income and everything that's been accumulated from one year to the next that hasn't been paid out in dividends. In retained earnings, we have a separate statement of retained earnings, and it's equal to the beginning balance plus net income minus dividends equals the ending balance, right? Okay, so that's what retained earnings is made up of. So this is the net income right here. So we take the net income, we get the beginning balance of retained earnings, add in net income, and subtract out dividends. So that dividends account is not really an account that shows up on the financial statements, really, right? That's the one account on your trial balance that doesn't really show up on the financial statement. I mean, it's subtracted out here in retained earnings, but it doesn't really show up on your balance sheet or your income statement. It's just kind of incorporated into retained earnings, okay? So let's see, what have we missed? Kind of my go-to list of things that we need to cover is on the balance sheet at the end of the chapter. Okay, supplies. What are they? Assets. Okay, so they go right here. All right, so supplies. Okay, I think that just about covers everything. So that's our summary of the accounting equation. So this is super important. If you don't have straight in your mind whether something's a debit or credit or which account it goes in, it's just going to make everything real hard from here on because we get in so much more detail. So like this should all just be within a week, you need to know this stuff cold, right? All of this kind of thing. Okay, so now we're going to look at brief exercises 1 and 2 because brief exercises 1 and 2 on page 133, these are just how to make generic journal entries, just regular, old, everyday journal entries. Okay, so in brief exercise 1, this guy's setting up his company and he invests $4,000 cash in exchange for common stock in a welding company, okay? So now we're doing this from the point of view of the welding company, right? So it says here this guy invests cash, but think of it as the welding company's point of view. we've received cash from this guy, right? Our owner. All right, so how do we, when you think of journal entries, it's important maybe, or easier if you start with what happens to cash. Your cash went up, right? So let's see, this is on the first. We received cash. We're debiting cash because it went up, and cash normally has a debit balance. So since it went up, we know that it's going to be a debit balance, right? And we exchanged it for common stock. So we're crediting common stock because common stock went up, and it normally has a credit balance. See? So we're not going to worry about the amounts here. We'll just worry about what happens with the debits and credits. Okay, so then on the third, he bought equipment on account. Okay, so he bought equipment on account. What happened to his cash? Cash did what? Nothing happened to cash. On account means what? Accounts payable. That's what that means. On account really, when you buy something on account, that means you didn't pay for it yet. You still owe them money. Okay, so accounts payable went up and equipment went up, right? Equipment normally has a debit balance. It went up, and accounts payable went up, and it normally has a credit balance, right? Okay, so then on the 13th, we paid $400 to the landlord for rent. What happened to our cash? Our cash went down, so that would be a credit, right? Cash went down with a credit. And what's our debit going to go to? Rent expense, right? All right, and then on the 21st, we billed this company for some welding work done. What happened to our cash? Nothing happened to our cash. So this is service revenue, which is normally a debit or a credit? A credit. Service revenue, see, is normally a credit right here. So we're gonna increase our revenue. And then what this guy owes us money, what do we call that? Accounts receivable. Okay? Good on that? All right. Now we're going to, let's see. Let's look at the next one. In the next one, this guy invested, this is a brief exercise too, invested cash and some equipment in the business. $12,000 cash and $2,500 equipment. Okay, so the business got cash. Its cash increased. The business's cash increased, and the business got this equipment, right? So the business is going to be able to use this equipment in the business. And what did they give this guy in return? He's now part of the business. He gets capital. He's a sole proprietorship, right? Or some kind of proprietorship. All right, then on the next one, we purchased supplies. We purchased supplies on account. What happened to our cash? Nothing. It's on account, so we're going to be crediting accounts payable, right? Accounts payable went up, so we credit accounts payable. And we received supplies. Our supplies went up. What kind of account is supplies? It's an asset. Until we use it, right? It's an asset until we use it. All right, and then 12, we performed services. Part was collected in cash and part was billed. So we received some cash, we billed some people. That's accounts receivable, right? And then we have service revenue. So all of these things went up. We paid our rent. We've already said how to do that. And then we counted our supplies. I'm going to skip down to 19. We counted our supplies and determined that $270 of those supplies are still on hand. So this one's kind of mixing in an adjusting entry. Let's think about that a second. When we did the supplies, we purchased $500 worth of supplies. So here's our T account right here. Supplies, we debited it for $500 right here, right? But now what they're saying is we've counted the supplies and there's only 270 left. We want our ending balance to be 270, right? So we want to adjust our account to only have 270 in the balance. So we're doing an adjusting entry here. So what do we need to do to get it from 500 to 270? We want to have a credit over here for 230 to supplies for 230. And what are we going to debit? Supplies expense. So we're moving part of our asset into an expense account. Okay? So that's an adjusting entry. We skipped on up to the adjusting entries already. Any questions about these plain old, mostly plain vanilla journal entries?
The one on the second, with the capital increase? Or?
Yeah, that one increased. Yep. Yep. What else? Okay. All right. So now we're going to talk about adjusting journal entries. That's on page 97. So let me tell you, you guys are going to have a project to do, not a project, a quiz, a week from today. And we're going to spend the whole class period on the quiz. And the quiz is going to be the main parts of chapter 3. And it's going to be something that y'all do together in a group. You're going to be in groups of 3, and you're going to sit around and talk about the answers to it, or maybe do it all yourselves and then compare answers and come up with a, answer in general. And so the idea is here to prepare you for the test, right? So I found that this really helps get you ready for the test, to talk about it with the other folks. And then so what I would need you to do between now and Monday is come up with a group of 3 and to finalize that. And when we get here, yeah, you have a question? No? Okay, gotcha. Okay, so that's what we're going to do Monday. So don't miss class Monday, right? And because that's one of your grades. I think quizzes count like 8% of the grades, and there's going to be 4 of them. So, that's something you need to be here about.
I actually do have a question.
Okay.
Just going back really quick, the supplies expense was 230, but the supplies left, is that 230 or 270? 270. 270
is left in the account.
So do we put for supplies on the 19th 270?
This is our journal entry.
Okay.
Yeah. So we're doing this journal entry. This is that.
Okay.
Yeah, this is our adjusting journal entry. So this is when we bought the supplies right here, and this is when we adjust it right here.
So that 230 would be the decrease.
That's the decrease. Yeah, we increased it here, we decreased it here. And then this is our balance when we counted it per our count. Okay? All right, so now we're going to adjusting entries. Okay, like I said, on page 97, we have 4 kind of adjusting entries. So maybe y'all talked about adjusting entries a little bit in principles, right? A little bit. This is supposed to be a review, right? So you talked about them a little bit there. So we have 4 kinds of adjusting entries, and the first 2, we're going to talk about them kind of in the order that they are there. The first one is prepaid expense. Okay, prepaid expense, like we said, is a debit. It's an asset on the balance sheet. And how do we get it? How do we get prepaid expense? We get that like when somebody, when we pay an expense, we pay an expense before the expense is an expense, right? Before we need to expense it. So the cash happens, let's say this a different way. The cash is before the expense, okay? So like we pay our cash here. Cash is paid in this period. This is this period, but our expense happens in the next period. So like, for instance, with supplies, we paid for the supplies before we used the supplies, right? So all of these prepaids, all of these journal entries that we're going over, the cash is in a different period than the revenue or the expense. So this is an important concept for you guys to know if the cash is before or after the revenue or the expense, okay? When I say that's an important concept, I mean, this is like the reason that we have a prepaid or, any other kind of these adjusting entries. And when you think about it, the cash is on the balance sheet, right? And the expense is on the income statement. All of these journal entries are going to involve one thing that's on the balance sheet and one thing that's on the income statement. And all of them are going to have cash mismatched with the revenue or expense. Okay, so you need to know what is causing the prepaid, that part of it. And then you also need to know some examples of it, be able to recognize these things. So the first one is supplies. We have talked about supplies already. Kind of when we go through these, I'm going to kind of focus on what your entry would be when the first part of your entry, when like your initial entry, and then your adjusting entry. Okay, so when we bought the supplies, we did one like this, remember on our example? When we bought the supplies, what would our entry be? Our cash went down, and then supplies went up. And supplies is on the balance sheet, and cash is on the balance sheet, right? This supplies is an asset and cash is an asset. This is what happened when we bought the supplies. This is when our cash was paid right here, okay? And then what happened when we used the supplies? This is our adjusting entry. This is our adjusting entry when we used the supplies. This initial entry was just our plain vanilla entry, right? Okay, so this AJE stands for adjusting journal entry. Okay, so when we used the supplies, now we need to make an adjusting entry because we need to adjust the supplies account right here for what was used. So we're going to credit that supplies account for the amount that was used because supplies went down, right, when we used them. Okay, and then what are we going to debit? We're going to debit the supplies expense account because that went up, okay, for the amount used, whatever amount was used. Okay, so the supplies expense account is on the income statement, and this supplies asset account is on the balance sheet. So see how one of them is on the income statement and one is on the balance sheet. And it's because our cash does not match our expense, which is out here in the, in another period after we receive the cash. Okay? So are we good on that one? Okay, the next one we're going to do is prepaid insurance. Okay, so when we buy an insurance policy, we usually, we always have to pay for our insurance in advance, right? So the insurance company makes us pay in advance. Car insurance, have to pay that in advance. Why is that? If they made you pay it afterwards, you'd say, well, never mind, I didn't need any insurance, nothing happened. No catastrophe happened, I don't need any insurance. So you have to pay for it in advance. And when you pay for it in advance, then you have something called prepaid insurance, and we're going to credit cash because it went down, right? So this is when we first buy the insurance, when we pay for the insurance. So in other words, our insurance, we're paying for it with cash. We're going to pay cash for the insurance in this time period, but we're going to use the insurance in the next time period, right? So when we buy the insurance, it's this. And then when we use the insurance, or really just when time passes by, after a few months have passed or whatever, whenever it's time to do the adjusting entry, this is the adjusting entry, we're going to expense the amount that's used. So we're going to reduce the prepaid insurance and we're going to debit insurance expense. Okay? So now see, this is very similar to this entry up here. Insurance expense is an income statement item. It's an expense account. And prepaid insurance is a balance sheet item that we're reducing. See how this is just very similar to that? All of the prepaids, this is what we're talking about now, all the prepaid expenses are going to be kind of a similar way of doing things. Okay? So we have several prepaids. Let's see, the next one is depreciation. Okay, so depreciation, not really what you call a classic prepaid, right? But it kind of has the same connotation of you're buying something in one period and expensing it in another. So we're just putting it in this category, okay? So depreciation, we're going to buy a long-term asset. That's what we're doing with depreciation. And when we buy the long-term asset, we're spending our cash to buy some piece of property, plant, and equipment, right? So this is an asset that we put on the balance sheet. I mean, this is a long-term asset, really, not like prepaid. It's a short-term asset. Prepaid is a short-term asset. This property, plant, equipment's a long-term asset. But we're buying an asset to put it on the balance sheet. So this is what happens when we buy the asset, right? And then what happens when we depreciate it? We want to record the depreciation expense. And this is an adjusting journal entry. Okay? So we want to depreciate this particular asset. The way that we do that is we have the standard journal entry where we're going to be debiting an expense and crediting an asset on the balance sheet, right? So what expense do we debit? Depreciation expense, right? Depreciation expense, and we're going to be crediting a contra asset, which is accumulated depreciation, right? Okay? All right, so that is depreciation, which is kind of like a prepaid, or it acts like a prepaid. We're just putting it in that category because it kind of acts like a prepaid here. All right, so that's kind of all of the prepaid accounts. Now we're going to go into unearned revenue. Okay, so this is another one of our big categories, like prepaid expenses. We're going to go into unearned revenue. And, okay, so what is our kind of problem with this account that we're trying to solve? And what's happened with our cash? In this situation, we're receiving our cash before we are earning the revenue. So our cash is happening before the revenue is earned. Somebody's paying us in advance of us earning the revenue, okay? Okay, so when somebody pays us, what kind of journal entry do we make for unearned revenue? Our cash is increased, so we're going to debit cash and credit. Normally when somebody pays us, for some kind of revenue thing, we're going to be crediting revenue. But in this case, since we haven't earned it, we're going to credit unearned revenue, right? Okay, so cash is, increasing. Unearned revenue is increasing. Cash is an asset. Unearned revenue is a liability. And both of these are on the balance sheet, right? Okay, that's when somebody pays us. That's our plain vanilla entry, okay? But now we want to do an adjusting entry, okay? So why do we need to adjust on this? What is the purpose of us adjusting? It's simply we need to do an adjusting entry when we earn the revenue, okay? When we earn the revenue, we need to have an adjusting entry because we can't leave it here in the liability forever, okay? We want to take it out of the liability, so we want to reduce unearned revenue for the part that is earned, okay? So when we earn our revenue, what are we going to be crediting? Revenue, right? Okay? We're going to be crediting revenue, which is an income statement account, and unearned revenue is a balance sheet account. See how these, we have an income statement and a balance sheet account on our adjusting entries. On all of these adjusting entries, we have something on the income statement and something else on the balance sheet, right? So here, depreciation expense is on the income statement and accumulated depreciation is on the balance sheet. So all of the adjusting entries are like that. And in all of them, cash happens before the expense, or the revenue, or cash happens before or after the expense or revenue. In this case, see, cash happened here and the expense or revenue happened here. See, it's mismatched in different periods is the reason that we're having to do an adjusting entry, okay? All right, so unearned revenue, I think we've covered all of that. Any questions about these two? Okay, so now we're going to do the last two. Okay, so the first one that we're going to do is accrued revenue. Okay, so accrued revenue, in accrued revenue, what happens here? The cash is before the revenue. No. The revenue is before the cash. Okay, we're accruing our revenue. We haven't received cash for it yet. So in other words, we perform the services before we get the cash. So our revenues in this current year and the cash is, or current period, and the cash is in the next period. Okay, so our revenue comes first. Yeah. All right. So what are some examples of that? When we earn the revenue, we're going to increase our revenue account. So the classic example of this is when we perform services for somebody on account, right? That's kind of what they'll say. We perform these services and we build them. We did something for somebody and we billed them, they haven't paid us yet. So a lot of times when we perform services for somebody, then they pay us in cash and we're all done. Debit, cash, credit, revenue, right? But they haven't paid us in cash in this case. So we're having to record the revenue when we earn it, because that's, when you record revenue is when you earn it, or it is, when do we record revenue? When do we recognize revenue? When do we recognize revenue? We talked about this last period. There's two things that have to happen. One was we have to earn it. It's realized or realizable, right? Close. Okay, so realized means we get the cash. Realizable means we record an accounts receivable, right? So this is, it's realizable here in this situation, okay? So that's an important concept. When do we recognize revenue? When it's realized or realizable, and when we earn it, okay? All right, so when we earn the revenue, we're going to debit accounts receivable, which is on the balance sheet. And then we're going to credit revenue, which is on the income statement, right? And then now we're going to do the adjusting. Well, this kind of doesn't work so hot. Let's just say that we receive the cash. We receive the cash. Okay, we're going to record this right here is the adjusting journal entry. That's the problem. Okay, we won't. No, I'm not going to label any of them that, actually. We're just going to leave it like this. All right, so we earn the revenue and we receive the cash. When we receive the cash, we're going to debit cash and credit accounts receivable. See, we're reducing this accounts receivable that we set up here. We set up the accounts receivable right up here. When we increased it, now we're going to reduce it for the amount of the cash. Cash went up, accounts receivable went down. Both of these are on the balance sheet. Kind of a little different pattern that we saw in the one before, where now our balance sheet and income statement accounts are up here, right? Okay, so that's about the only example of accrued revenue. This is, one of our four major kind of adjusting entries, right? Okay, so the next one is accrued expense. Okay, so this is one of our four kind of entries also. And in accrued expense, what has happened is that we want to accrue an expense in this period, but we're not going to pay for it until next period. So our expense is before the cash. Okay? All right, so what are our accrued expenses? We have a lot of them, or several of them, let's say. We have several accrued expenses. This is, and we start off with kind of a tough one in a way, interest expense, okay? We're on page 105, okay? We're doing interest expense. So what happens here is we want to record the interest. Now, why are we recording the interest? Well, okay, this is the generic interest expense scenario. We have a note payable that we take out on something. The note payable goes for a year, let's say. Okay, so y'all might have a car payment, right? And the car payment, you pay it every month, and the interest happens every month as you pay it down. Do you know what I mean? On a monthly thing. But if you have instead a long-term note that's for a year, a lot of time might go by in between, payments, and all of this while you're really owing interest each month that you haven't paid. So at the end of the period, let's say if we cut off the period in December 31st, you actually owe for this interest that hasn't been since the last time you made a payment, right? Okay? Y'all may not have a year-long note. Nobody wants to wait a year to collect money, right? So, but there are, a lot of companies have year-long notes. They only make payments like once or twice a year. Okay, so when we want to record the interest expense is what kind of account? of these? An expense account, which is a debit. We're increasing our expense account with a debit. This is when we record the interest. And what is our the other side of this entry? Interest payable, because we owe this interest now. We're increasing interest payable, which is a liability, and interest expense is an expense account. This one's on the income statement, and this one's on the balance sheet, right? Okay, so this is when we record the interest. Now, the second part of this is when we pay the interest. When we pay the interest over here in the next period, we're going to, credit cash because we're paying it and our cash is going down, right? And we're going to debit interest payable because we've set up this payable. When we pay the payable, we're going to decrease the payable and credit cash. All right, so that's the basic idea of interest expense, but how do we come up with those numbers of how much to expense? So the formula on page 105 of how to come up with the amount of the accrued interest is, are y'all taking finance yet or going to take finance? You're going to take finance soon. And, here you might go into more detail about this, but the principal amount of the note, okay? So in this case, this was a $50,000 note. Has anybody ever lent you $50,000 and said, pay me back in a year? Well, this is what's happened, see, right? $50,000, pay me back in a year. We take the principal amount of the note times the annual interest rate, not the monthly interest rate, but the annual interest rate. So in this situation, it was 12%. And then we're going to multiply it by the fraction of a year. How much of a year has gone past? And what are we talking about? From the last time you paid the note here all the way to here, the end of the period. This is the part of the year that we're talking about. You're accruing interest for this period between the time you paid it last time and the end of the period, okay? So this fraction of the year in this case was 1/12. So this is just a month, right? So it's usually, actually not many people accrue interest on the basis of months. It's usually on the basis of days, like how many days out of 365, right? So that's the normal way to accrue interest. But this is the simple way of months, okay? So this is an or here. So this is multiply this out and you get the amount that we're going to accrue. We're accruing interest in this case for 1 month. So that's accrued interest. That's one of our accruals. Okay, the next accrual, any questions about the interest part first? We're going to do if we get there. I think we are.
What's that word supposed to mean above the 50,000?
Principal. So that's the amount that you borrowed, the principal amount, okay? All right, so the next accrual is salaries. Okay, so for salaries, we want to record the salaries expense is our first entry here. Okay, why do we have to accrue salaries? Okay, so let's just go back to that. When you work for a company, people are usually paid one of about 3 or 4 different ways. Okay, how am I paid? I'm paid monthly. I used to work for a place where 2 people in the company were paid annually. In December sometime, we figured out how much to pay them, and they got paid annually. Would y'all like that idea? How about that? No? It all depends, yeah. But I mean, yeah, if you're making a ton, but then now you have to live off that for the whole rest of the year. Okay, so some people are paid annually. I've only seen one example of that, but I'm paid monthly. When am I paid? On the last day of the month. Does anybody have to ever accrue my salary? No. Because like the financial statements are the last day of the month. The university's year end is June 30th. I'm paid on June 30th. We call it a day, we're done. They don't owe me a penny, right? Not a penny, I'm all paid up, okay? But some people here are paid, I think some people might be paid twice a month, I'm not sure. If they're paid twice a month, does anybody have to accrue their salary? No. No, they're all paid up. On the end of the month, they get paid. They get paid on the 15th and the end of the month, they're all done. They're all clear at the end of the month. Okay, but sometimes people are paid weekly, right? Weekly. So, does anybody ever have to accrue those salaries? No? So what about if they're paid? Okay, so the problem occurs, well, the answer, let me just say, is yes. Those are the ones you have to accrue, the weekly salaries. Because the end of the week isn't always on December 31st or June 30th or whatever your last day of the month is, right? The end of the week could fall on Monday, Tuesday, Wednesday, you know. No. It could fall on the 1st or the 2nd or it could fall on the 30th, the 31st, the 1st, the 2nd, like that. So depending on when the end of the week is, you normally have to accrue the payroll for the weekly people or bi-weekly that are paid every other week, okay? So what you have to do is look at the calendar, okay? So here's the calendar. We have Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday, let's say. Okay, so if Friday, let's just say, no, Wednesday. If Wednesday is the end of the month, December 31st, falls on a Wednesday, people have worked this day, and this day, right? They've worked 3 days in this year, and they're going to get paid, let's say they get paid on a Friday, for 2 days this year, right? They get paid in this time. So the cash happens in the next period. See, in our little thing, let's do it down here. In our little thing like this, in this period, we want to accrue the salaries, or we have the salaries expense in this period. And our cash isn't till this period, right? This is, what are we talking about? Accruing expenses here. So our first step is to record the salaries expense. So at the end of the period, December 31st comes, and we see, my goodness, we owe these guys for 3 days. What do? We're making this journal entry over here sometime, or usually you make the journal entries like the next week or two after the period closes, and you see we've paid everybody for this big period right here for 5 days, but part of that should be in last periods. Okay, so we're going to record salaries expense, which is a debit, salaries expense. The debit went up. It's an expense account. This is an expense account on the income statement. It went up, and we're going to credit salaries payable because as of the end of the year, we owe these guys for 3 days, right? We owe those guys for 3 days. Now, how do we come up with the amount of what we owe them? How do we figure this out? So usually what you do is you come up with like a ratio. So in this case, what is our ratio? The ratio is 3/5. We owe them for 3/5. There's 5 days total. We owe them for 3 of the 5 days. 3/5 times the amount of the payroll. Okay, so how do we get that? What is the 3/5? So the 3 is the part in this period, and the 5 is the total period. Okay, so this is our fraction. The part in this period, the 3, and the denominator is the total period. Okay? And we multiply that times our total payroll. So if our total payroll is $1 million, you know, then 3/5 of $1 million goes in this period. All right. Questions about, now, okay, this is what you look for in an accountant. What do you want to happen? December 31st is on a Friday. You're cheering, right? No adjusting entry. If it's on a Friday, because it's just all goes in this period, right? And so then you're good. So a lot of the time, everything works out fine for you, but usually, just everywhere I've ever worked you've had to accrue salaries because somebody works weekly. And what I say is, let's just put everybody on a monthly payroll, and then be done with it. Be easier on the accountants, right? Maybe not for the workers, but it would be easier on the accountants. Okay. I think if we took a vote on that, people would rebel. What's that?
They're paid hourly, and if they get paid monthly, you know, are they paid?
Like after the month's over. Work all month and then get paid. Might not work. Okay, so now we're going to do these exercises. Okay. Oh, did we skip bad debts? Aha, bad debts. We don't want to skip bad debts. Okay. Bad debts. Okay, so bad debts. What happens when you sell something to someone on account? Okay, if you make a sale on account, what do you do? We're going to, on account means in this case what? Accounts receivable, right? On account could mean accounts receivable or accounts payable. If we make a sale on account, then we record the sales revenue, which goes up, and we record the accounts receivable because they haven't paid us. Now, do we leave that accounts receivable on the books at that amount forever and ever? Okay, yes, for one company that I worked for, everybody always paid their bills. So that was great. The world was fine, and there was no work to be done on this. If you can assume that in your company everybody always pays their bills, then we're good. No need to adjust anything on this. But if in fact you think that some of these people, some of these accounts receivable people are not going to pay, what do you have to do? You have to record the bad debt. Okay, or bad debt expense, as I like to call it. Bad debt expense, right? Okay, so we want to record the bad debt expense, or somehow or another we're going to estimate, we're going to guess how much of this is a bad debt. We don't really know, do we? Who's not going to pay? We don't know. How much is not going to be paid? We don't really know that either. Why are we even bothering with this? Why are we bothering with recording the bad debt expense? Because we want to put the expense associated with this people that aren't going to pay, we want to match it with the revenue. See, we've recorded the revenue right here. We want to, record some kind of thing in the same period. This right here is in the same period as the revenue to match the expense associated with that revenue that we have, that we've recorded. Okay, so when we make that journal entry for the expense, we're going to increase our expenses, which is a debit, right? So we're going to debit bad debt expense to record the expense. which is matched up in the same period as this revenue. Okay? This goes on the income statement, and this goes on the income statement. And then what are we going to credit? When we record the bad debt, we're going to credit allowance for doubtful accounts. Okay, why is that? This is something on the balance sheet that is a contra asset, right? That's going to offset this accounts receivable that we've recorded. On the balance sheet, allowance for doubtful accounts is right beneath the accounts receivable, and it offsets that amount because it normally has a credit balance and accounts receivable has a debit balance. Okay, so now we've recorded bad debt expense in the same time period that we've recorded the revenue. Okay? Now, in another chapter, we're going to talk about a couple of different ways to estimate what the bad debt expense is and to come up with this number. And so it's going to get a little more complicated than this, but this is the idea of the journal entry. So that's why it's so important, to kind of nail down these ideas so that when we get to later chapters, they make sense. To, when we get, the nitty-gritty part of it. Okay, so now, any other questions or anything? Okay. All right, so now we're going to do these brief exercises, and we're going to start with brief exercise 3. So what we're going to do is go through the exercise, and then we're going to figure out what type of situation we have here. So our choice is one of 4 types of situations, right? We're on page 133. So we have like 4 types of adjusting journal entries, and we're going to try to identify which type of adjusting a journal entry we have. Okay, so this guy, this Crow company pays $15,000 to the insurance company for a 3-year insurance policy. The year end is December 31st. Now, they want us to do the adjusting or the journal entry for Crow on July 1st and December 31st. Okay? So on July 1st, we're doing Crow's. Crow paid $15,000. Okay, so in July, paid $15,000. What we think about first is what happened to our cash. Our cash, in this case, went down, so we're going to credit cash for $15,000, right? And it's a 3-year insurance policy. They've paid for the insurance in advance, right? What do we call that? Prepaid insurance. Okay. Okay, so they paid $15,000 in advance. Okay, so this is the entry that we make when we pay in advance. We pay for it in advance. Now, at the end of the year, in December, we want to expense the portion that has expired, okay? So now let's just get our timeline going here. In July sometime, we paid the cash, right? July 1st, we paid for the cash. And then this is a 3-year policy. So this $15,000 lasts us 3 years, right, for the insurance. How much has expired? That's what we want to know. How much right here has expired? Six months? So it's July 1st, so July, blah, blah, blah. 6 months. So 6 months has expired out of 12 months? 3 years? 3 years? So out of 36 months, right? 6 months out of 36 months has expired. Or, half a year out of 3 years, or however you want to do that, So we divide that all out, and it's 2,500 has expired. So if we say, this is 1/6 times 15,000 is 2,500. That doesn't sound right. 2,500? Is it? Okay, gotcha. All right, so 2,500. Then what are we going to debit and credit?
Expense.
So we want to get rid of part of our prepaid insurance right here. We're reducing, see, we put in 15,000, we're reducing it by 2,500. Yeah, that is the right number. Okay. And then we're going to debit insurance expense. This, we want to, record the expense, some expense in this time, and then leave the rest of it to be, next time. We're recording the part here that has expired. Okay? So does that make sense? Okay, good. Now we're going to look at it from the other point of view. This is from Crow's point of view. Now we're going to look at it from the point of view of Zubin. Okay, Zubin is the insurance company. And what happened was Crow paid us early. We received cash early. When we received the cash in July, what are we going to do with it? We're going to debit cash because our cash went up for 15,000. And what are we going to credit? Insurance revenue? Unearned revenue. Because it's paid at the beginning of the period and we haven't earned anything. So we're going to credit unearned revenue for the entire $15,000. Are we doing fine so far? Okay. Then in December, we're going to want to record the revenue that's been earned. So we're going to estimate or figure out how much that revenue's been earned and record that much. And how do we do it? This same way over here. And 2,500 of it, as a matter of fact, has been earned. So what do we do with revenue that we earn? What happens with revenue? Credit revenue. And we're going to debit unearned revenue. See, we're reducing this 15,000 by 2,500 for the amount that we've earned. Now, you know what? There's several ways that this kind of thing could go wrong. For instance, sometimes in some problems, we'll figure out that whenever they received the cash, they messed up and didn't put it in unearned revenue. Matter of fact, a lot of times when you're, go into a firm and it's a small firm that just has a little bookkeeper, the little bookkeeper just puts everything in revenue. So I call her Myrtle. Myrtle, the bookkeeper, whenever she gets cash, she just puts it in revenue, right? Because that's what normally happens when you get cash. It's a revenue account. But then so a CPA might have to go in, or whoever's adjusting the books goes in and makes an adjusting entry to take out the parts that haven't been earned. So it could be that this is going to happen in a slightly different scenario. This was the scenario they gave us, right? But if it turns out that Myrtle didn't do this correctly and we have to adjust it, then we'd have to make different adjustments, okay? So you have to kind of look at the scenario and see if it worked out to be what we were expecting. Okay, so that's 2 of those. So the next one we're going to do is number 5. And what kind of adjusting entries were these guys? The first one was, like, of our 4 choices. Okay, yeah, of the 4, the total 4, on page 97. Yeah, deferral, both of these, yeah. Prepaid, okay, so the first one's a prepaid expense. That was the first thing we went over, right? Where, okay, so prepaid expense where we paid for something in advance. And this one down here was unearned revenue, right? Because we received the cash before we earned it, okay? All right, so those are the two that we went over. All right, now we're going to do number 5. So what we're going to do in the next class period is we're going to kind of do a whole financial statement. You know, we're going to kind of do a big problem and do a financial statement and put all of these accounts on a financial statement. And then remember, the next Monday we're going to have that group thing where everybody needs to be here and have a group. When you might want to talk to folks on your way out too, or you might want to figure this out, who's going to be in the group. All right, so number 5, we have a weekly payroll. They're paid on Fridays. They're paid $8,000 on Fridays. They work 5-day weeks. This is exactly the problem that we kind of did before, right? This is the kind of the demonstration that we had where we have Monday, Tuesday, Wednesday, Thursday, and Friday. They work 5-day weeks. On Friday, they're paid $8,000, but Wednesday is the 31st. So how many days are in this period? 3. 3 days are here, right? And 2 days are here. So as a fraction, what's our fraction? It's these days, 3 over the total days, 5 times the payroll amount, which is 8,000. So that is 4,800. Okay, so we want to record 4,800 in this period. 4,800 is going to be an expense in this period, and the rest is going to be an expense in the next period. You know, the 2/5 times 8,000 or 3,200 is going to be expensed in next period. So in other words, 3,200 in the next period and 4,800 in this period. See how that works? So what do they want us to do now? They want us to record the journal entry on December 31st. On December 31st, what do we need to do? We need to accrue the expense that's happening in this period, right? So how do we do that? We want to record the salaries expense and salaries payable for this period is $4,800. At the end of the year, we owe them this $4,800, but we haven't paid them, right? So now they get paid on January 2nd. So this is when we're going to accrue, and this is when we're going to pay. So when we pay them on January 2nd, we're going to pay cash of $8,000, right? And, you know, part of that, there are 2 parts of the $8,000, the $4,800 and the $3,200. What are we going to do with the $4,800? This is what we're going to offset the salaries payable. We're going to get rid of salaries payable. Now salaries payable is going to have a balance of 0, right? After we make this entry. And then this $3,200, remember we were going to expense that next period, so we're going to debit salaries expense. Okay? Anything about that one? Okay. Okay, we have a couple minutes. We're going to try to do the note payable part. Okay, that's number 8. Because, I think it helps to do the one with the numbers. So number 8, this company had a note, well, this is a note receivable, actually. They had a note receivable of $12,000. It's a 4-month, 10% note dated October 1st. Okay, so on October 1st, we had a 10% note dated October 1st, and it was a 4-month note. October, so this is October, November, December, January. This is our 4-month note, 1, 2, 3, 4, right? Okay, then it's a 10% note. Prepare their entry on December 31st. What kind of entry are they gonna, we want to record the interest. How do we determine how much interest, unless they cheat and tell us? Okay, see here they told us the amount of the interest, right? But let's say they didn't tell us that. We take the principal amount times the interest rate times the fraction of a year, right? So in this case, the principal amount was $12,000. The interest rate was 10%, and the fraction of a year, now there's where I'm in a pickle, right? The fraction of a year, it's a 4-month note, right? So what are we trying to accrue here? We're trying to accrue 3 months, right? 3/4. That's what a lot of people say, times 3/4. No, so this is an annual interest rate, so it's times 3/12, okay? Because it's 12 months for the whole 10%. We're just dividing this annual interest into little fractions. It's times 3/12. So that's like a common, that's like very common mistake.
Oh, so it'd be 3/12 would be 3/12,
3/4. Okay, what you could do is figure out what the interest would be for these 4 months, which would be a different thing, and then get 3/4 of that. But the annual interest for this, if we were doing it annually, is $12,000 times 10%, or $1,200. We're going to have to pay $1,200 for a year. How much do we have to pay a month? $100. $100 for a month, and times 3 is $300 for this period. Or you could do it this way, 12,000 times 10% times 3/12, and you would get $300. The point is, you can get confused over thinking that it's a 4-month note. That part of it's kind of irrelevant to the problem. What we want to know is we're accruing this period right here, 3 months out of 12 months, okay? Because it's an annual interest rate. That's really a common mistake, and that's why I wanted to get to this. Okay, we're going to hurry this up real quick. On December 31st, we're going to record this as an interest receivable. This is where they're owing us the money. And how much do they owe us now? They owe us $300 now, the way that we calculated it that, and interest revenue. So we're making a journal entry, an adjusting journal entry, to record the interest that's due to us. And now when they pay us, at the end of the period, at the end of the 4 months, they're going to pay us back the $12,000 plus interest, right, at the end of the period. So the $12,000 plus interest, how much interest did they owe us? They owed us $400 total, $100 a month, right? So they're going to pay us $12,400, okay? So the $12,000 was the amount of the note, like note payable, let's call it note payable. The $12,000 is the note payable, so we're going to take the note payable off the books. And then we've already recorded some interest payable. That was $300. See, this are interest receivable. This is a note receivable. Okay, that's a note receivable. Note receivable we're taking off the books, and we're this interest receivable right here. That's this. Okay, see, we're getting rid of that interest receivable. All right, and then we have interest revenue of $100. We need to record this $100 of interest in January. This is happening in January. Okay, this one's a little bit, because you have the accrued interest, the interest receivable, and the interest revenue, you know, it's a lot to remember. Okay, so any questions about that, I guess we can do after class, okay? And I'll see y'all on Wednesday.